Are we in an AI bubble? AI giants like OpenAI are now worth $500 billion, even while losing $7.8 billion this year itself. According to MIT, 95% of the companies investing in AI are actually getting zero returns. So, are we seeing the next Dotcom crash in slow motion? Now, before you panic sell all your AI stocks, don't. Because in this video, I'll show you what exactly is going on, where we are in this bubble, and how to protect your investment portfolio, even if it bursts. And stay to the end because I'm going to reveal one company that could actually win the AI race. Now, since ChatGPT, the world has actually gone insane. Money has been flooding in, valuation is exploding in the AI sector. But here's the question, are these profits real or just hype? Some experts are telling us that we have hit stage 3 of a market cycle, which is euphoria, the most dangerous zone in every bubble. That's when everyone is convinced that AI can change the world, but nobody actually stopped to ask if the numbers actually make sense. If you look closer, there are already cracks forming beneath this hype. The deals, the spending, the valuation, all are showing early signs of overheating. So let's break it down. The first red flag, we are talking about circular financing. Here's what's happening. Nvidia invested billions into OpenAI. Then OpenAI used that same capital to buy Nvidia chips. Nvidia also owned about 7% of CoreWeave. It's a private AI data center company. Nvidia is paying $6.3 billion to CoreWeave for cloud capacity, while CoreWeave is spending over $20 billion this year, and more than half of that is going back into buying Nvidia hardware. Meanwhile, OpenAI is signing a $22.4 billion deal with CoreWeave, a $300 billion cloud partnership with Oracle, and another deal with AMD, buying 6 gigawatt of chip in exchange for 160 million warrant shares. Now, if exercised, those shares could give OpenAI around 10% ownership in AMD. And over at Microsoft, it's just as tangled. Microsoft has invested $13 billion in OpenAI, sells AI cloud service to OpenAI, and then also report revenue from the same partnership. Now, the point is, when you zoom out, it's actually really hard to tell how much of this investment are actually driven by real AI demand and how much of this revenue is actually just recycling through the system. This is circular financing, one of the patterns that show up usually just before a crash, especially during the dot-com crash, when companies were technically growing, but mostly by selling to each other rather than real user demand. The second sign is this: record capital expenditure. Now, in just 1 year, the big 4 hyperscalers, we are talking about Meta, Google, Microsoft, and Amazon, have poured a record of $364 billion into buildings and upgrading data center. That's roughly the size of Portugal's entire economy. And McKinsey projects that by 2030, the world will need $5.2 trillion in total to keep up with the whole AI computing demand. That's an enormous bet on just one trend, especially when you consider that the infrastructure for data center only lasts about 3 to 5 years before they need to be replaced. Now, some argue that this is just a capex, an investment that will eventually pay for itself, but that doesn't really hold. You can't compare it to like building railway, where steel tracks can actually last hundreds of years, so it kind of pay for itself later. Many of the investment in the data center doesn't last for ages, mostly 3 to 5 years. Like say a chip. A chip will last for about 3 years before it can be used for the highest tech calculation. It will have to slow down. Then after about 5 years, you need to replace those chips. The cooling system, power setup, all has to change after a couple of years. The point is, the payback window for data center investment is actually really short. So very often before these facilities can truly pay themselves off, another massive round of capex spending is already on the way. And next, we are talking about valuation. You see, the Magnificent Seven, we are talking about Nvidia, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. They make up about 1/3 of the S&P 500's total market value. And most of that rise isn't from profit. It is from AI's potential. Some say, relax lah, this is normal. These are profitable company. Eventually with AI, they will grow into the valuation. But here's the truth. This is the same story that every investor will tell themselves during every bubble in history. And the pattern is always the same. When expectation rise faster than actual earning, reality will eventually catch up. Right now, a big part of the AI surge is also fueled by venture capital. You see, VC firms are pouring record dollars into AI in 2025. In 2021, the VC firms actually only allocated 16% of their total investment to AI. Today, we are looking at 71%. That is a massive jump. But here's the real question. What happens when this money dries up and say VC firm, PE firms start pulling out their investments? Of course, the valuation of this AI company will start to drop, and this will cause the bubble to burst. Ultimately, in every bubble, people don't stop believing. They just run out of money to believe with. Now, of course, many people are also arguing that this time is really different. Because back in the year 2000, most of these internet companies were built on traffic and hype, and many of them have no profit. On top of that, the Feds were raising interest rate to cool an overheating economy. And that was the reason that many of the companies during the time couldn't survive. But today is the opposite. AI giants like Microsoft, Google, Amazon, they're all highly profitable and they're sitting on massive cash reserve and multiple income stream. On top of that, instead of tightening, Fed is actually preparing to cut interest rate as inflation eases. This means capital is becoming cheaper, and this gives companies room to keep investing aggressively. And for those who are saying that the valuations right now is too high, well, think again. In the Dotcom era, Cisco systems traded at over 100 times earning, and many of the top tech stocks had median PE of 52 times. Today, if we're looking at the Magnificent 7, they are trading at around 26.8 times. That's roughly half of that. Even chip stocks are valued at only 43% of their .com peak multiples. So structurally, it is different, right? But psychologically, it does feel quite familiar lah. Back then, investors believed that internet will change everything we know about the world. And they were right. Today, the world is very different because of internet. But let's not forget, most of the internet companies still went to zero, and the same could happen here. Now, I believe that AI could absolutely reshape the world as it is already right now. But not every company riding the wave will survive the storm that's coming. The story can be right, but the price can still be very wrong. So all this raised the real question. What happens if a bubble does pop? Because when optimism turns into panic, history shows that fallout doesn't just stay inside the stock market, it can spread really fast, even outside. During the dot-com crash in 2000, Nasdaq fell 76% from over 5,000 to barely 1,100. And within months, thousands of startups vanished. It doesn't just affect the stock market. In Silicon Valley, unemployment rate spiked up 3% to 7%, wiping out hundreds of thousands of tech jobs, and wages dropped by 13.5%. And if we're talking about today, the AI boom is actually really tied to real economy. Bloomberg estimate the AI demand for electricity alone will fill $350 billion of nuclear power built out in the US. So if AI spending collapse, the impact could ripple far beyond tech, hitting energy, construction, finance sector that have scaled up just to feed this whole AI boom. So when that happens, everything that's connected to the capital chain could feel the shock. So yes, bubble can burst, and when they do, it can get really messy. But the point of the video is this: we are not here to predict when a bubble is going to pop. We're going to talk about how should we position ourselves so that even when it pops, which it will eventually, how can we be ready? So firstly, as an investor, you want to manage your exposure. You do not need to dump all your AI stock, but do not let them dominate your portfolio either. Now, according to a market strategist, Michael Mortensen, he suggested that when a stock drops below a 50-day moving average, it is often the first sign of weakness. So when you see that, you may want to trim about 15% of your holding, lock in some profit, while keeping the skin in the game for a long-term upside. Next, you want to diversify your investment into sectors that have a low correlation in AI. Now, you want to look at industries that can perform even if AI spending cools off. For example, healthcare, which is driven by demographic, not AI. It's all about aging population that keep a demand steady, right? And we look at utilities and energy, which are essential because whether AI go up or go down, people still need to use electricity. And tangible real assets like gold or property, which often act as safe haven when speculative markets start to unwind. Finally, when you invest in a company, you really want to focus on cash flow and balance sheet strength. So even when the market gets really choppy, these companies that generate real cash can survive. All in all, you want to look for businesses that can benefit from AI, not depend on AI. At the end of the day, in every bubble, there's always an opportunity. I believe you can probably find one company that may not only survive the chaos, but can come out stronger because of it. Who could it be this time? If I had to choose one company that's the best shot, not just at surviving, but at winning the whole AI race, this will be the company, Google. When it comes to AI, Google controls all three layers that matters the most: the chip, the cloud, and the LLM. Google designed its own AI chip called the Tensor Processing Unit, or TPU. It's a custom-built chip for machine learning, specially made for Google. This means that they don't rely on NVIDIA like everyone else does. And here's the key, you see. Many companies that depend on NVIDIA have to pay an expensive premium for those chips, so their margins are lesser. But because Google uses their own hardware, they actually not just control performance, but they also control their financial margins. In other words, they can make more money. Next, the cloud. Google Cloud is one of the largest AI-ready infrastructure in the world. It powers both its own product and other companies' AI operations. You see, AWS and Microsoft Azure have strong cloud network too, but they still heavily depend on NVIDIA's hardware and external model to make everything work together. Finally, LLM, the large language model. While OpenAI has ChatGPT and Microsoft partners closely with them, Google owns its own stack. We are talking about Gemini and Palm. They are trained on massive real-world data from Search, YouTube, Maps, Chrome, and Gmail. Having said that, all those things are part of Google, so there's a huge data advantage that give Google an unmatched edge in both accuracy and reach. So I think this is why it makes Google different from all the other AI companies. It doesn't just use AI or develop AI, it owns every part of it: the chip, the cloud, the model, and user base. On top of that, Google already has a profitable business model: Ad, Search, Cloud, Android, all of which can be amplified with AI integration. It also has the cash flow to invest. It has the balance sheet to survive through a downturn and still have enough to pay dividends with those kind of massive investment. So, while other companies are trying to figure out where AI can fit into their business, Google is already building AI into everything it does. And that's why, even if this bubble bursts, I believe Google may not just survive, it could even define what comes next. So, question is, are we in the AI bubble? Well, maybe, most likely. We are probably deep in the euphoria stage, where excitement blurs into overconfidence from investors. But remember, in every boom brings opportunity, and the winners may not be the loudest or the fastest, but they are the ones that can build real value and stay disciplined while everyone else is trying to chase the hype. At the end of the day, our job as an investor is not to predict when the market is gonna burst. We just have to get ready for it. So what we need to do is actually diversify our bet, focus our cash flow on fundamentals. Because whether the bubble bursts next year or the next 5 years from now, if you know how to position yourself on what's to come, you will profit from it. Anyway, if you think this is a bubble, leave a bubble emoji in the comment section and tell me what you think.